Hey, what's up, Blay? Okay. All right, is my mic on? Yes. Okay. All right, ladies and gentlemen. Let's get this up here. Looks like market's flipped on its head today. Tesla's down a little bit, but we are here to talk about a specific scenario today. Let's get this wider. Looks like. There we go. All right, right. Blockchain's up. Master's up here too a little bit. Bitcoin's looking like it's getting a handle on itself, so that's fun. Okay, so I was doing some work the other day, and Garden Farmer put me on chat in the stocks chat room, putting on some chat. Let me put up the articles from the other day. All right, so this gentleman, retail trader, made $7 billion in Tesla. And what this article reminded me of was interesting because this gentleman, I won't read the whole thing, and he started with a good amount of money. I don't know what he started with, but it was a good amount. He ended up buying Tesla stock and Tesla options to increase his Tesla stock position. He would actually exercise his options, which most people in this general. Oh, crap. This ad freaked me out. I was getting audio in my headphones. I'm like, what is that? And it was gradual. That's funny. Um, this guy was getting he was getting more shares. Hey, what up? Hero Priest. So let me see. Confirmed he has 6.31 million Tesla shares, and he held 1.82 million options, giving the right to Tesla between $450 to $550 a share. I don't know why I didn't think about this before. Maybe this will also work with Bitcoin. Maybe this will also work with other assets you want to hold really long term. But here's the thing. Is it holy crap? This kind of little light bulb, and I'm like, this can be excellent. So I wanted to go into how does this look like? What are the circumstances behind where this could be a winning strategy now that we're thinking about it. So I don't know, it doesn't say what this guy started with in this article, but he ends up obviously with $7 billion worth of Tesla shares. And I don't know if they're counting, because they mentioned 7 billion. So I don't know if they're talking about um, the optionable shares or not. I don't know. But it got me thinking. And the thinking led me to some numbers, and the numbers are starting to lead to some pretty good things. And I wanted to explore it. And this probably won't be the only session I do like this. I don't know, because there's a lot of numbers to go through. If anybody wants to chat, I'm also on Discord, by the way. I'm not on there a lot, but JJ was gonna jump in here. He's good with numbers and stuff too, so I wanted him on there. See if he can jump on here. Anyway, okay. So let me do a couple of things. Let me change this. It's going to be kind of a busy screen here, I think. So here's an options chain. Let's do it for Tesla. And this is an empty spreadsheet. Obviously, these two are meant for each other. I mean, a spreadsheet or an options chain is really just a spreadsheet that was in an orgy and had lots of babies, because it's just spreadsheet on steroids. Okay, so bid ask. I could probably change this out a little bit. I think the main point here. I can't just have, okay. I have to have one apparently. And I can't change column size. Lovely. Maybe I'll go a little wider here. And where's my videos? There we go. All right, I'm gonna go wide here for purposes, and okay, cool. This is really about audience participation as well, FYI. So if anybody wants to jump in here, feel free. Okay, so this is a strategy essentially around buying exercising calls and when it behooves somebody to do that. I would argue by saying if you want to exercise an option, you want to hold something really long term. I mean, because if I buy this call at 11.50 for Tesla, it's going to cost me $340, right? That means in the short term, it's got to get to $14.90 for me just to break even. So from that perspective alone, depending on the bias, collateral, I don't know if you could use, I'm not sure if collateral is the term, but you have to buy it with real money. So here's my situation. My situation is I do have some Tesla stock that's worth some dollars, and I also have some Tesla options. So I have stocks and options. Okay. So let's just put that up here. I have stocks and options. And you could also have cash. I don't have a lot of cash left, but cash works as well. Anyway, so in this situation, you're paying $14.90 to buy Tesla at the money, and by June 16th, 2023, you're hoping it goes past 1,490, and everything past that you'll make $1. Right? So, and you're paying $390 for this, $345 for this option. So instead of buying Tesla for $1,199, you're buying it for $345. If that makes sense. You're paying $34,500 for that right. Okay? So let's get just the basics of that out of the way. And that's what's happening here. All right? So if you're just trading short term, I mean, options are fantastic. I've done exceptionally well trading options short term. I've also lost a lot of money trading options short term, but overall I'm up. So can't complain too much. You know how it goes. Cheyenne doesn't know how it goes. His chart only goes up and to the right. So, okay, so short term, but what about long term? A stock like Tesla, like in all honesty, I do want to hold my Tesla stock if I can. I mean, I know I'm a market timer, so I'll probably get stupid and sell during the next top or whatever. But longer term, I really want to hold a lot of Tesla stock. I mean, as much as I can. This guy's worth $7 billion because he's holding Tesla stock, not because he's trading all the time. So, think of big stocks that you stocks that you like. Tesla, I like Tesla. Maybe what's another one that you could like? You could like long term. I like Net. Cloudflare long term is awesome. Maybe somebody likes Amazon. Maybe somebody, just pick it. Maybe somebody likes Riot Blockchain. Maybe somebody likes Bring my watch list in here for a minute. NVIDIA. You like NVIDIA a lot. Maybe you just want to accumulate more and more of these shares. Okay, so that's kind of the impetus right now that we're working under. Okay, is that we're gonna hold these longer term, because here's the thing with options. Options only last about 2 years. Options go out 2 years. That's about it. So if you have a time horizon past 2 years and you really want to accumulate something, I've done a little bit of the rudimentary math to this, and depending on the runs the stock makes, this can be really advantageous. And I want to work out exactly what advantages we're going to have and some of the mechanisms behind them. So getting some of the backstop out of the way. Okay, I'll talk about my current scenario. All right, so I own, due to some bad trading decisions, I used to have 1,200 Tesla calls. Let's run that scenario. But I currently have 1,450 strike prices. Okay, so pretty close to the 1,200, which I don't own anymore because I'm stupid. And I currently own 1,450s. So since we're discussing exercising options, let's be clear. This means buying $120,000 worth of Tesla shares. And this means buying $145,000 worth of Tesla shares. Okay, so that's the first thing out of the way. I mean, this is a fairly extensive strategy. Hey, what up, Mike? Jump in for 5 minutes. Cool. Maybe hopefully it lasts a little longer than that. So I do want to be clear about this, that this can be an expensive proposition, obviously. So you would have to have 100 shares of Tesla to buy this, and 100 shares of Tesla to buy these. If you're going to sell Tesla shares to buy Tesla, so this becomes advantageous if you have a deeper in the money call. So right now, take the 1450s. I think I paid something like $68. So these are actually like 1510 or something like that is what I paid for these, right? But 1450 is what I'm going to buy them for. So I'm just going to leave. So let's say Tesla gets up to $2,100, which was one of my next targets for Tesla, is 2,100, just based on some technical stuff, and also that Apple price chart, which I've gone over a bunch and I won't go over again. Say this gets to 2,100, and say I have 100 shares of Tesla, right? So I can still buy Tesla for 145,000, but I'll have 210,000 in Tesla. So in theory, I could sell these minus that. I could get 100 shares of Tesla, still have 65,000 left over, and by that I could do this divided by 2,100, and I'd have 30 extra shares. So I'd have 130 shares. I'd have 130 shares of Tesla. Okay. So I mean, that could be pretty substantial. That's a 30% increase in your Tesla shares just by the price increasing. I mean, it's a good amount, but this is a little bit, I don't want to call it like margin trading, but it could be a little similar to margin trading with Bitcoin, because you're getting Bitcoin as Bitcoin's rising, right? Or some other assets. And that really isn't available in stocks. This may be one of the ways to do that. It's probably one of the ways to do that. So there's another way to look at this. So under this scenario, exercising the option. So I have 100 Tesla shares. It's worth $2,100, 210,000. I exercise another option that I bought, and the shares were 210. I exercised the option. So I have 65,000 left over, and I have 30 shares left over, and I have 130 shares of Tesla. And those could be worth $273,000. So it's a little bit like the compounding you're getting. So what about this scenario? That 1450. Let's just say what that option would be worth. Okay. So I've got 2100 minus 1450 plus 65. So I have my option's worth $715 at this point. And then, so that's $71,500. So what if it's, in this scenario, you'd be able to buy 34 shares of Tesla. If you took the option, sold it at 210, you're actually getting more shares just selling the option than exercising the option. Okay. Does that math work out? So I have 130 shares here. Now I should end up with 134. So they're not too far off, only 4 share difference. Did I do that right? I think I did that right. So 100 shares, 1450. Okay. What if I can get this formula working so I don't have to adjust it as much? So 100 shares, strike price, 145,000. All right, so this is going to be work with. So this is going to be equal to this minus this. And this is going to be equal yeah, that's what I ran into last time. This will be equal to this divided by this. So that changed something. It actually made it about break even. Okay. So that's going to be that divided by D5. And this is going to be equal to, wait a minute. Yeah, okay. It's going to be equal to this plus this. Okay, that makes a lot more sense. Okay, so in the 2100 scenario, they're break even. And it makes a lot of sense in that case because it's pretty much a break even scenario. Because the only thing that would change here, which would be advantageous to the options, is time value. So time value is a positive. In this scenario, you lose all the time value. You also lose the premium that you paid. But let's run through something else. What if we bought? Okay, so what if we had that 1200 call? How does that change things? Is it going to be exactly the same the whole time? Well, maybe I'm overcomplicating this. So in my scenario, I ended up with quite a few more options exercising than I did with the selling the call and just buying the stock. Save 100 shares. Hmm. $75. Why is this flipping me out? So, is it literally just a 1-to-1 no matter what I do? It doesn't make a lot of sense though. Okay, well, let's think about it here because hmm. All right. I don't know, maybe this is a bust strategy. I honestly thought there was something here. Let me look at my other spreadsheet I've got. Profit on shares, cost per 100 shares. This is proving to be a bit of a bust right now. I'm not sure what's different than what I have over here. So options are worth. So the first price I have here is 1,600. And so I have profit on shares, cost per 100 shares. So you still end up with more shares where they're selling and exercising. I mean, technically it is a dollar for dollar move up, so head and shoulders negated on BTC? Really? It looked good this morning, but I didn't really hawk at it. This is proving out to be a bust of a stream. Let's check that out. I was going to get to something profound. Well, oh, it's right here. Oh, yeah. Oh, yeah. Wait, that's not it. There we go. 4% for Bitcoin. What else? DOT. Oh, you set 3.8. Go general bull market. Nice. Good job. All right, so hey, what's up, Ellie? You sold Tesla today? Okay. Yeah, I'm trying to go over a strategy of exercising options to accumulate more Tesla shares. I'm trying to see what it is something wrong here. Well, I'm just trying to run through scenarios Exercising 1200. Well, I'm just running through scenarios here because I think it's good to do homework. So so these are all strikes right here. I can probably make this gray like an options chain or something. Yeah, then we'll go to 15. Yeah, possibly. I've been thinking 2100 for a while now, just kind of based on percentages and prior runs of the really big winners like Apple in these scenarios. Um, so okay, so I'm trying to run the scenario of you have some Tesla shares or just a bunch of cash and you buy some options. You want to exercise your options um because I don't know. Yeah, well, I've got to 2023 for that particular scenario. Because I mean, speaking, they're having a big chat yesterday in Slack about kind of the valuation of Tesla, and talk about that for a second, I guess. I don't know how it's going to play out. We never do, but everyone kind of has the 2030 timeline for Tesla for the most part, right? Like that's kind of everyone's impetus is that. So I mean, the question is, what's the overall valuation you can give to Tesla, and at what time do you expect it to get there? And then obviously we all know that market action is a different scenario. So in 2021, let's just say it's valued at like what do we at like 1.2 trillion, but in 2030, because everyone has this 2030 time horizon. Gary Black stops at 2025, kind of, but in 2030, when they're fully moved up, they're making 20 million cars a year. What do you value, Matt? Are you valuing because JJ's new spreadsheet is $45 trillion, which I think is bonkers. Um, the old spreadsheet was 25, which is still pretty bonkers. Nice, Ellie. How you doing, Ellie? You getting sleep, bud? I don't know if you've told anybody else in the community, so I ain't gonna say nothing. But so I mean, everyone's like, "Oh, it's too expensive." But like if you look at 20, so yeah, this actually brings me to the some Tesla forecasts. Oh, what do you want me to call them? Everybody? I can say everybody. Tell everybody. So in this spreadsheet by 2021, we should be at 500 million market cap. Next year we should be at 1.3, which we're there right now. Um, 2 next year, 2.2 next year, 3 the following year, and these are based on growth rates. So here's the year-over-year percentage growth rate. So you have the gigafactories opening, you know, big percentage, and then you get a really big market cap based on that. But we know the market front runs all of this. If Tesla's supposed to top in 2030 and flatline forever, it'll probably happen in 2028. It's just the way the market works. So in this in this scenario, you've got a 2.2 billion or trillion market cap in 23, a 3.8 trillion market cap, and then so on and so forth. And in reality, this is based on once you get past 2025, then robotaxi comes into the mix. So it gets a little bit more strange from there because no one really knows how this is going to work out. I think we can see to about 2023, maybe 2024, but it's day by day. So I think by 2023 they have a 2.2 trillion market cap valuation on Tesla, and that's based on some. It's really based on how many battery packs they can produce, and these are coming straight out of Elon's mouth, essentially. In reality, so they're supposed to produce 2 million battery packs, and then 5, then 8, and 13, and maybe this will ramp up a little bit as they do a bunch of megawatt stuff. But I mean, this is what they're supposed to do, and it's based on battery pack. It's based on some inflation, and it's based on the average. See, JJ added inflation to his inflation. He already did inflation right here. He's forgetting that, I think. He already added inflation. But yeah, so it leads you to share prices. So here's 2021. We were obviously double that already. And then 2022, 2023. But yeah, I mean, the question is how is this supposed to play out? So with the hype and everything, I mean, it can get to anywhere. It can get to a lot of places in reality. But then you look at Gary Black's Twitter feed, and I find this guy to be a pretty good source of information. He's actually a legit dude. He's not just some Twitter crazy thing. Um, I always put the most random people. This is Gary Black. He's a dude. He's been around for a while. And let's see. Here we go. So he looks out a couple of years. He's actually an institutional investor. Has been an institutional investor. So um, what's my performance this year? I guess if next one right, I will hit 50%. Oh gosh, not very good. I screwed up the first half of this year. Um, like 20, 30% or something, maybe. Keep in mind how badass last year was. And then it continued going like the first month, and then it was kind of garbage after that. And now it's coming back with Tesla moving up. So it's not very good. All right. Yeah, I don't know, 20, 30% so far. Anyway, so this guy, so he's got, it's kind of hard to see here, but he's talking about Tesla going out. I guess he does have 2030, but he has a big gap between 2025 and 2030. And he also goes over a lot of the other high value companies. And according to this guy, Tesla's still pretty cheap. So still very cheap at 64 times 2023 EPS with 55 forward 5-year EPS growth. So no mega cap stop is that cheap except for maybe Facebook. 2023 peg except for Facebook. And then so he takes it from looking at a little bit further against all kinds of stuff. Investment strategy. Well, that's his strategy. He actually opened his own ETF, I think it was, or maybe it was a hedge fund. Yeah. But yes, going back to whatever cash lines in your hands, that's kind of what I'm trying to do here. I'm trying to figure out, having a bunch of options is advantageous if you have the cash to exercise them. Because, I mean, let's just go through a situation real quick. Um, so I do have some 2023 calls right now. And let's say I was really smart, which apparently I wasn't. I wasn't thinking about this strategy. But let's say you bought the calls back when they were at $500, you know, just throwing something out there. Strike price of $500. And today at 1,200 bucks, these would be worth obviously a lot more than that. It'd be worth 700. But you probably would have bought these. So these would be worth $700, but you probably would have bought them for, I don't know, what's at the money today? 300. That's with volatility increase too. So that wouldn't be 300. Anyway, let's just say I can actually look through analyze and think back here real quick. So we can go back. Let's say you bought it May 17th because you're awesome. $235. You'd have paid $235. And they're worth today $687. Okay, $235. They're worth $687. $500 strike price. You can exercise these options. So at some point, it'll probably be advantageous to either exercise them, or I guess you can just sell shares. So let's just take right now as an example. Let's just call it 1200 for easy math. We're at 1200, and so you would need 50,000 to exercise this. You need $50,000 to exercise this option for a $500 strike price, getting 100 shares of Tesla. Okay, so your profit is $45,000 is your profit right now on this one. If you have Tesla shares, say about 100 times 500, you're at the 500 shares. So all you have now is the 500 shares, or the 100 shares. You paid 50,000 for them. That's some pretty easy math. Could have done that one. And it's going to cost you 50,000 to exercise for 100 shares, but your Tesla is now worth 120,000. Yeah, see, this does work out. Damn it, this does work out. I don't know what I screwed up here. So in this real world scenario, if you bought it at 500, you're worth 120,000. If you want to get another 100 shares of Tesla, you could actually sell some of your shares, right? So there's 120,000 divided by 50,000. Oops. All right, so you're selling 42 shares to get 100 shares. So you're going to have 68 shares, 58 shares? Yeah, 58 shares plus your 100 shares. So you have 158 shares. So you've essentially just increased your Tesla stack. Say you bought one call option and one lot of 100 Tesla shares. You've increased your stack by 158, by 58%, which is pretty cool. So that's not bad. Yeah, versus if you sold today, you'd have a 452 profit, and you wouldn't be able to buy that many Tesla shares. You'd be buying 45 Tesla shares. So you come out ahead. So I've done kind of a piss poor job at managing this experiment this morning, but I think the main thing here is that options only go out 2 years. It's more advantageous probably to add your Tesla shares stack if you have that multi-year time horizon. If you think we're getting to 10,000, if all you think is we're getting to 10,000 by 2025 or 2030, which is possible. I mean, that's firmly possible. It's probably better. It's probably better to exercise if you can buy deep enough in the money. So I mean, in this scenario, that would have worked out exceptionally well with the $500 scenario. So let's say time value is a positive. Okay, so let's say you have, I think my average share price is 700 on Tesla right now. And I have 100 shares. And let's do 1,200 for the price. So equal this times this. I don't think that actually matters much in this, but whatever. Yeah, I don't know what to do with that. Okay, and then I bought So it's 120,000 value right now. And then let's say I bought one of those 1,200 strikes. I'm really bombing on this. Because right now it's a 1-for-1. Which it would be a 1-for-1. So I guess where does it get advantageous to employ this strategy? I guess that's the question. And I would need to do a huge spreadsheet to answer that. I'll have to do that later today. Maybe I'll come back at some other point with some better answers. But this is what I wanted to go over. I didn't do a great job of it. But you know, if you're buying in those dips, like that, you know, you just saw you could end up with 58 additional Tesla shares, which is pretty valuable. And at this point, you were buying them for $500. Even though you paid an additional $238 for them, it doesn't really matter. I think the point is that you're buying those additional Tesla shares. And if you're trying to stack, if you're trying to, you know, like that's an additional. So you paid $23,000 or something for that, because we had the numbers. Yeah, you paid $23,000 for that option. And today they're worth $120,000 in shares, where vis-a-vis your profit would have been $45,000, right? So you actually benefited tremendously by being able to exercise those options. So there's going to be a threshold, probably a cascading threshold, probably fairly linearly as it becomes less and less, or more and more advantageous. So you really don't want to exercise at the money. You want to exercise fairly deep in the money. And 1,200, I mean, you're looking at like a, yeah, I got to get going too. Kids are about to go to school. So 500 is 41% of 1,200. So it's up about 60%. It's probably 58%. No, it's not. Anyway, I'm bad with math. But anyway, am I making any fucking sense here today? I'm just getting frustrated. I can't do what I want to do with the maths. Anyway, I think this does make sense, but so I think it probably does make sense to buy a longer term, especially if we're in those dip situations like this. If you bought it at the money call, even if you bought it, and see, here's the other thing, maybe if you bought it out of the money call, that's another thing I wanted to look at. Say at 500, you know it's getting back up to 900. So say you bought a 900 call. There we go, 129. So say you bought a 900 call instead of a 500 call. Let's see how this works out. Probably not as good. You probably want to buy deep in the money. If I bought a 900 call, then I'd be buying for 90,000, and I'd be able to buy less shares. Yeah, I'd buy about 10% because it'd be 90,000. I have to sell 90,000 of Tesla out of my 120,000. And so I would very likely end up with less. So it's more advantageous to buy deeper in the money, even if it costs you more capital up front. So there's a balance between, do I want to exercise? Because here look at that. So you could have paid $600 for a $200 strike price and bought a shitload, or $700. So 600 or 700, 730. Wow. So deep, look at that deep in the money. At the bottom of the trough, if you know it's the bottom of the trough and you got a deep in the money scenario, you're paying 6 versus 7. So you're getting actually a little bit of a discount. So you're paying 600 versus 700. If you have the capital, that could be really advantageous because then you're only selling 20,000 shares of Tesla versus 50,000. Wow, that's pretty powerful right there. So you want to spend 600 instead of 700. Or, what the hell did I click? I don't know. Or if you go out of the money, let's say you go to 1,000, you're spending 100, but you have to sell 100,000. So it's cheaper in the moment, but later it's going to cost you a lot. So I go from 200 to 1,000. Oh no, I'm sorry. I'm only paying 400 here. My bad. So I'm paying 400 versus 200. Stupid. Paying 400 versus 200. So at that point, that'd be 40,000 versus 20. So it's a 20,000 difference, but a 30,000 purchasing difference. Okay. All right. Sliding scales. I'm gonna have to work on this later. I gotta go, guys. Thanks for watching me beat my head against the wall. I'll see you guys later.